So, what really happens when a total beginner tries day trading for the very first time? We're about to find out. We're going to follow a one-day trading experiment to see the real raw lessons you can only learn when there's actual money on the line. Let's dive in. Hey, think back to the very first time you got behind the wheel of a car. Remember that 10 and 2 white-knuckle grip on the steering wheel? That feeling of being just a little overwhelmed by all the mirrors and pedals? You weren't trying to win a race, right? You were just trying to figure out the controls and, not hit the curb. Well, that is the exact mindset we're taking into this trading experiment. The goal on day one isn't to get rich. It's all about learning the rules of the road, getting a feel for the dashboard, and, most importantly, surviving to drive another day.
All right, so what was the game plan for this first day out on the trading highway? Let's break down the initial strategy and the setup.
First things first, the plan was to keep it super simple. That meant sticking to equity trading, which is really just buying and selling shares of a company. More complicated things like futures and options? Nope, totally off the table. Because see, they often involve leverage, which is kind of like borrowing money to make a trade. It can amplify your gains, sure, but it can also amplify your losses. Definitely not something you want to mess with on your first day.
And the strategy itself? Also very, very basic. We're not talking about deep technical analysis or staring at a dozen complex charts here. Instead, decisions were guided by a simple combo of checking the business news, seeing what the trading community was talking about, and understanding the three fundamental commands: buy, sell, and that absolutely critical one, the stop loss. That's your safety net to get you out of a trade automatically if it goes south.
But as anyone with experience will tell you, the market doesn't really care about your plan. And on this day, reality had something completely different in store. And this is where our story gets really interesting. So the initial idea was to buy stocks that looked like they were ready to go up. Seems simple enough, but right after the opening bell rang, the market just tanked. It took a complete nosedive. So what was supposed to be a day of buying suddenly turned into a sea of red, and the entire plan had to be thrown out the window. So what do? How can you possibly trade when everything is going down? Well, this introduces a really key concept called short selling. It's a strategy that lets you profit from a stock that's falling. Think of it like taking the classic buy low, sell high, and just flipping it on its head. With shorting, the goal is to sell high, then buy low. I know that sounds a little weird, so let's walk through it. Here's how it works. In step 1, you borrow shares of a stock and you sell them immediately at the current market price. Let's just say it's $100. Then you wait. If you're right and the stock price drops, say down to $90, you move to step 2. You buy the shares back at that new lower price and return them. That $10 difference, that's your profit. It's a way to trade with downward momentum. But here's the thing. Trading is never just about mechanics or strategy. It is a huge mental game. And all that chaotic market action, it triggered a really powerful emotional response that started to hijack the entire decision-making process. And this is where the two classic villains of trading showed up: greed and fear. When a trade was actually making a bit of money, greed would pop up and whisper, "Hey, just hold on a little longer." And you know what? That often turned a small win into a loss. And when a trade went into the red, fear would just start screaming, "Make it back now!" And that just leads to impulsive revenge trading. This emotional roller coaster just led to one classic beginner mistake after another. Things like chasing losses with bigger, riskier trades, holding on to winning positions for so long they actually turned into losers, and completely ignoring that growing mental fatigue that just clouds your judgment and leads to even more bad decisions. So, after all that chaos, at the end of the day, the account showed a tiny profit. But wait, that's not the whole story. You have to remember that every single trade you make comes with costs, like brokerage fees and taxes. After you factor all that stuff in, a small gain can easily disappear and even turn into a net loss. It's a huge lesson in the hidden costs of active trading. So, after that crazy first day, what are the real takeaways here? Let's distill this whole experience down into a few actionable lessons. A couple of huge observations really stood out. First, the market's overall direction was way more powerful than any single stock choice. You know the saying, "A rising tide lifts all boats"? Well, a falling tide sinks them too. Second, and this is a big one, the exit strategy was so much more important than the entry.
A good exit can save a bad trade, but a bad exit will absolutely ruin a good one.
So this brings us to the 3 most important lessons from the entire experiment. Number 1, respect the market. It is the boss. You can't force it to do what you want. Number 2, your exit is more important than your entry. You need to plan how you'll get out before you even get in. And number 3, which might be the most important, trading is a psychological battle. Control your emotions or they will control your account.
And that brings us right back to that driving analogy. The goal of day 1 is not to make a profit. It's to learn, to make some small mistakes, and to survive, to trade another day. Because in trading, especially at the beginning, the most valuable currency you can earn is experience.
So as you continue on your own journey, ask yourself this: what's the one lesson from today's experiment that you'll focus on in your own practice? Because having that focus, well, that's the difference between deliberate practice and just plain gambling. Thanks for watching.